driver behind that bullish call is the fact that we're returning to a more normal world. And the goal in trying to figure out where we're going to end 2021 is trying to figure out what the world is going to look like in 2022. And as we look ahead over the next 12 to 18 months, we see something where COVID is hopefully beginning to fade as vaccines get rolled out, and we are returning to a more normal environment. The economic activity is continuing to move forward, although we are beyond the bounds at that point. We are still continuing to have good economic momentum, and those two ideas should carry equities higher as we once again return to that more normal world that we used to live in.
Yeah, and we will get there. It's going to be a tough couple of months, but Patrick, we've been talking a lot about this idea of the roaring 21s and 22s. The second half of next year being a blowout. And I think that 2022 could be one of the greatest consumer-led economies in history as we all just kind of bust out and a lot of pent-up spending. And by the way, frustration is let out. But does that necessarily mean stocks will follow, Patrick? Because isn't the run we're seeing now pricing so much of that already in?
Well, it's a good question, and I think the run that we're seeing now is pricing so much of that in for cyclical sectors. So right now what we're seeing is when we have days where we have positive vaccine news, or for example, Janet Yellen nominated for head of Treasury Secretary, that cyclical rotation is incredibly pronounced. Leadership is energy and financials. It's because those are the two groups, along with industrials and some others, that benefit from this positive backdrop. But many of those sectors, those pro-cyclical sectors, energy, financials, industrials, and materials, are beginning to assume this normalcy into their estimates. And our expectation is actually to see leadership from technology throughout much of the year, because in reality, that's where the opportunity is for those companies to continue to grow their businesses. The cyclical rotation is already being baked in. We would still continue to have people look at technology, even though they look expensive now. Their businesses are just so robust. So that's where we think leadership's going to be. If you look at consumer spending, good spending is very high right now as many people will remain at home. I think we're going to see a big shift to services spending, thinking about restaurants and other forms of entertainment, hopefully over the next 12 to 18 months. That tends to be less positive for the market because many of those are small businesses. Think of your restaurant on the corner. So we will see a huge move in consumer spending. Whether or not that is directly impactful to the market, I think we need to be seen, just because services tend to be less equity sensitive.
Yeah, I know that listen, who cares what the Sullivans do, but the Sullivans have already booked a number of trips for next year. We're going to take them regardless, I can tell you, Patrick. But there's other factors at work. I mean, I understand that COVID and the vaccines get all the attention as they should. Yesterday really was life-changing news in many ways, but we've got interest rates. We've got a potential stimulus package. We've got broader fiscal stimulus, maybe an infrastructure bill. How do the financials look to Credit Suisse? Because they've been laggards. They've been a bust and frustrated many investors now for years.
Yeah, and I think financials is the one area in that pro-cyclical group, those financials along with energy, materials, industrials. Financials is the one area where you have that opportunity. The economic activity has been so powerful, so industrials and materials has really re-rated, has really gone higher because economic activity has been so strong. Interest rates haven't risen nearly as much as they should have, and we think they're going to continue to move higher over the next 12 months, and the interest rate backdrop will improve. And what that's really going to do is going to drive profitability for the financial sector and for banks specifically. So financials is really your opportunity within that pro-cyclical group to continue to find areas where it's going to work. And that's where we would encourage investors to look, is within financials, as opposed to the industrials and materials complexes, which have already really re-rated on the back of that optimism around some of the stimulus packages which you just mentioned.
There are any sectors of the market that you dislike, Patrick? You know, the ones that have maybe made a little bit of money and you're like, you made the money, sell the stocks, move to somewhere else like the financials.
Mm-hmm. So defense defensive sectors, and they're typically your utilities, your staples, your REITs. Those are areas where you often own those stocks because you like the dividend yield. If interest rates continue to move higher, you just have a better relative opportunity within many other sectors in the market, and we're actually underweight many of those traditionally defensive sectors. So that's where we encourage investors to look at opportunities to maybe sell and then move into areas like financials or perhaps even technology for those people who have a longer time horizon.
Shepard Smith here. Thanks for watching CNBC on YouTube.